Everyone, just wanted to welcome you to the taxes, how taxes and other risks affect retirement income. I'm Raz. This is Daniel.
Hello. And we're with Higher Ground Financial Group, but this is who we are. This is our family.
So Daniel is my eldest son. As you see on the right-hand side is my whole family. I have 13 children, and he's my eldest son. He got married about a year ago, and now he welcomed the new baby.
So baby Esther was born recently, and so I'm really excited. I'm a new father.
And I'm a new grandfather. All right, let's get on. So what do we do?
We also have a ministry, Conquered by Love.
So our family, we did adopt 8 children, and we started Conquer by Love Ministries to help parents overcome trauma in children's lives without medication and without institutionalization. So we have a lot of resources out there. If anybody has an interest, you can go to conquerbyLove.org and take a look. We have over 40 books written to help parents with their children. So we are a local firm right here in Frederick and Leesburg area. Right now we're mostly on the web as opposed to in person because of COVID, but we are available for in-person meetings as well. And what do we do for our clients?
So we focus on 6 things. Number 1 is reducing taxes, reduce risk also, reduce fees and costs, increase retirement income, increase protection, and be able to pass more to your family if that's your desire. We are fiduciaries. At their website right there. But now we're going to go into what we have planned for today.
And before you guys think this is just a sales seminar, it is not. It's going to be a lot of good information. And that comes to this slide. Insufficient data. That's what this is. You guys don't have enough information. We're going to give you some information. Hopefully that'll help you make better decisions.
Let me know in the comments if you're a Star Trek fan also. I thought this was a clever slide. Insufficient data leads to poor choices. And so make sure we have all the data so that we can make the right decisions. So you're here because you worry about your money. You're either retired or soon to be.
Not making a salary or not saving anymore.
So you're afraid of losses. If you're afraid of running out of money. And we see this all the time with people that come to us, whether they have $1 million, $5 million, $10 million. They're all afraid of, okay, I don't want to spend too fast because I don't want to run out or I want to leave money for kids. And so that's a lot of worry, a lot of stress. So what are some of the questions people have for us?
So if you're retiring, you should be able to answer these questions. Number 1, how much can I safely withdraw?
How long will your money last?
Can I guarantee I won't run out of money?
And can I protect my assets from losses?
How much tax will I pay?
How much will I lose in the next market crash?
Can I reduce my fees?
And is it okay to finally start spending some of my money now that I've accumulated and saved and set aside money for all these years?
What if my spouse and I pass away?
Or just one of you? What happens then? Does the income stream stay? Do you still have income? And can you leave money to your beneficiaries? So these are some of the questions people have. And if you can't answer these questions, then it means your plan is based on hope and luck. And
that's not a good place to be.
That's not a very good place to be. So let's give you some tools on how to create a better plan.
So this is a financial mountain. All your life you've been climbing this financial mountain, working hard, putting aside money, saving money, and all the different resources that are at your disposal. And now you're at the top. You're about to retire and you're about to go down the mountain.
So is the achievement really reaching the top of the mountain?
No, because all your life you've been putting away money for retirement. So the goal really was retirement.
And to get down safely, right?
Yeah.
Because 2/3 of accidents actually happen on the way down from Mount Everest. And that's something a lot of people don't realize. It's a lot more dangerous to distribute your assets in retirement than it is to accumulate. And why is that?
It's very similar to climbing a mountain. When you're climbing up, you fall forward and catch yourself. But when you're climbing down, you fall forward, there's nothing to catch yourself against, you will tumble and get hurt. It's the same thing in finances. You don't have time to recover. There's a lot of things that while you're working, you can make mistakes and recover. You have time, but time's not on your side when you're retired, and you don't have that time to recover.
So our agenda for today, we're going to start with a quick market update because a lot of our clients and the people that we've been talking to recently have been very interested in what's happening in the markets. Then we're going to focus on taxes. We'll do an overview of the new tax laws, some other retirement pitfalls, and some tips for minimizing your taxes.
And then we'll do a couple of case studies and more specific answers at your convenience at the end.
So you're welcome to send us a question during this webinar. If we have time to get to it, we will. Otherwise, we'll have to answer all your questions in more specific time when you meet with us.
Right, and you can click that button right now and schedule your own appointment with us if you choose to do so. It's free. It doesn't cost you anything. and you'll gain a lot of information from there. All right.
So remember what we said, insufficient data leads to avoidable consequences. So what are some of these things that a lot of people have insufficient data on? Well, here's some real news. These are actual news articles within the last year or so. Rob Arnott, founder of Research Affiliates, believes the traditional 60-40 portfolio is going to pay somewhere between 0 to 1% over the next 10 years. That's not a whole lot.
That is almost
a
nothing.
60-40 portfolio of stocks and bonds paying less than 1% over the next 10 years. Market Watch. The stock market is poised for a 40% drop. This is after the last market crash of last year, and then it came back since then. But they're still predicting there's a 40% drop coming soon.
It's built into the market right now. It's going to happen.
And again, late last year, these stocks are trading at more than 10 times of their sales. Only once in history has that happened before, and that was in 2000, right before the dot-com bubble.
That was 3 years of negative returns. I know some of you guys remember that because it was really tough on some people.
Here's another piece of news, and this is an interesting one. This talks about 6 companies: Facebook, Apple, Amazon, Alphabet, which is Google, Netflix, and Microsoft. Just those 6 companies have much higher earnings than all the rest of the S&P 500 and really all the other countries. And these 6 stocks, among a few others, but these 6 stocks especially are what are driving the market returns.
So what does this chart show? The blue line is just those 6 stocks and what they have done. And then the red line is the S&P 500, and the yellow line is all the other countries and what their economies have done.
Excluding these 6 companies. And so think about that. When you feel like, are you diversified? Are you actually pretty heavy in these few stocks? That could be. Another fact, the CAPE ratio, this is Robert Schiller. They're again predicting that this is very similar to the dot-com bubble. What current market conditions are similar to that. And then there's one of these billionaires. Every few weeks, it seems like we see another billionaire that says, look, I have all my money in cash right now because I'm afraid the market's about to crash, and I want to buy then when it's on sale.
Yeah.
Nobody can predict when it will happen, but it will happen. And then, of course, last year we had a market correction of about 30 or 35%, and that came back really fast. Was that normal?
No, it was not. So why did it come back so fast? Well, the reason was that the government dumped $2 trillion into the marketplace because of COVID. When you dump and print that much money, it's going to go into the market, it's going to prop it up. And so artificially, the market came back.
And so the average historical recovery has been 4.5 years rather than 4.5 months just to break even. And sometimes it's longer, as we'll see in a minute. And so keep that in mind. It wasn't really normal what happened last year. We are still expecting a market crash pretty soon. Again, having insufficient data is going to lead to bad decisions. So we want to make sure we have all the data and all the facts. So in that line,
most of you have seen this type of chart. And so we're going to explain what this is. This is from January 2000, S&P 500.
To December 31st of 2020.
Right. So what did the market did? It looks like it did really well. So I'd like you to guess and see what has been the average interest rates from 2000 to 2021.
So go ahead and take your best guess. Leave it in the comments. I see some people were saying 8%. Some people say 10%.
12%.
7%.
And this mountain range does look really pretty good, pretty interesting.
It was actually only 4.58% over that long period of time.
Wow. So having all your money at risk in the market only got you 4.5% over 20 years.
Interestingly, the 20-year Treasury in January 2000 paid 6.86%. So you could have got that guaranteed, but instead, if you had your money in the market, you ended up getting 4.5% after 20 years.
So this is what happens. So in 2000, we had a big market crash of 50%, and it took us several years to get back to even. We had to climb 100% to get back to the loss of 50%. And then turned right around and lost 50% again. So then we had to come back out. So 13 years, it was a 0% gain, a net zero, and that's not including fees. And there's always fees.
And so the market has gone up tremendously since then. But the question is, what do you think is going to happen from here? And so the market doesn't actually do quite as well on average as you might think. And for those of you who are curious, if you had invested $1 million in 2000, how much would you have at the end of 2020?
If you were in the market, S&P 500, you would have $2.5 million. But
The 20-year Treasury would have actually gotten you 3.7 million with zero market risk during that time.
That's a 50% increase. See, that 1 or 2% difference makes a huge difference over the long term. And that's what fees also do. They eat up your money and you don't realize how much you lose. All right, so let's take a look at this a little bit differently. But if you look at every 15-year period since 1996, that means take a 15-year block and then take 1 year off, add 1 year, another 15-year block. What is the average rate of return over any 15-year period from 1996 to 2020?
A lot of you have probably heard the market does 12% on average. Well, actually, it's been a lot lower than that all those 15-year periods. Only once was it even close, or twice was it close to 8%. Most times it's in the fives. In fact, the average has been 4.73% for all of these 11 different periods of time since 1996. So the market is not nearly as aggressive and going up as you might think.
So this was eye-opening for me to see when everybody's saying, oh, you can get 12% in the market, 12% in the market. Nobody's gotten 12% in the market. It's not consistently.
And this is because we have a lot of bear markets. We have a lot of market crashes, a lot of market downturns. There's actually one every 7 years on average, and the average is 39.5%. This is all of the bear markets since 1929. It shows 39.5% and it's one every 7 years. But really the important thing is this research by a professor from Brigham Young University saying if you suffer a 35% portfolio loss, you only have a 61% chance of just breaking even over the next 5 years. So it's going to take you, if you're about to retire now, and
hello, folks. Thank you for flying Bear Market Airlines, and we're glad to have you on board. We only have a 61% chance of landing safely today. How many of you guys would stay on the plane?
In that case, though, landing safely just means you have all your money. You didn't gain anything, right? You just have your money back that you started with. So it's really scary stuff. And so we are poised for another market crash. Make sure you have that in mind. Losses are very hard to recover from.
So what does that mean? I mean, what does a loss actually mean to you? People think, well, if we lose money, the market's going to come back, and it does. But what do you have to gain when you lose something? So if you lose 50%, that means you have to gain a 100% just to break even.
And so let's say if you lose 40%, you have to get 66% just to break even. Even if you lose 20%, you got to get 25% just to break even.
And how many times in the market have you gotten 25% in a year? Not very often. So the golden rule is 5 to 10%. That means you can deal with a 5 to 10% loss and recover in the market pretty nicely. Because if you have a 10% loss, it's only 11.1% gain in order to recover, and that's doable. But ideally, between 5 and 10% is the only amount you could have risk. Otherwise, you could really end up trying to play catch up in your retirement years, which is not going to be fun.
If you have to pull money out at the same time as you have a market correction, that causes a double
compounding effect.
Right. So it's a cascading effect that's going to ripple through your whole retirement plan. Again, insufficient data leads to avoidable consequences.
He loves Star Trek, doesn't he? He loves Star Trek.
I do like Star Trek. So what's the only thing worse than a stock market loss? High fees. So how much are you actually paying in fees? We found this to be very eye-opening when we do this fee analysis for our clients. When they come to us,
everybody's talking about average rate of return. Nobody talks about fees. Why not? Because that makes a huge impact.
So a lot of people know that I'm paying 1% advisor fee. My advisor is picking stocks and mutual funds for me, and it's charging me 1%. Okay, great. But what about the other 1% that the typical money manager is charging for the funds that he's picking?
So if I take Daniel's money and I'm the advisor and I put it in some mutual funds, I get my 1% fee, but the money manager also gets his 1% fee in there.
And then there's mutual fund expenses that are built in, 1.23%.
For trading stocks, for buying and selling stocks, all those are built in.
1.4% average hidden cost of trading, and a cash drag, because a lot of these mutual funds have almost 1% in cash at any given time. And so it's really close to 5 or 5.5% in many cases. And it's quite often over 3% in fees. When we do the fee analysis for people, we're finding that they're paying over 3% in fees.
And if you remember, just a couple of slides back, you only got 4.58%
4.58%
return
in the last 20 years.
And if you lost 5.5%, you actually went negative, even though the market did pretty well, right?
And some of you may be thinking, well, my money actually did go up a lot over the last 20 years. Why did your money go up so much, a whole lot more than the market actually went up? If the market only did 4.5%, how did your money grow by much more than that?
because you've been continuously adding money out of your paycheck every month. That's really what the majority of the money is. We had a client that came in. He's a blue collar worker. He worked for, I don't know, 30 some years, and he accumulated $454,000. Okay, and he was very excited. That was a lot of money for him. And so we did an analysis, showed exactly how much he put in, how much the company put in, and we found out that he was only up $6,000. The $450,000 were actually from his contribution and his company's contribution over 30 years. He was flabbergasted. Why? Because of all the fees and all the expenses and costs that are built in. You don't see that.
So it's really important to make sure you know what your fees are and know what your actual returns are. So this is in 1999 to 2013, $1 million would have grown to $1.5 million. Notice I didn't start in 2000, otherwise you would have lost money. Or just barely broken even. But 1999 to 2013, $1 million grew to $1.5 million, but that's with no fees.
That's if you did it all yourself and didn't pay anybody any fees.
As soon as you pay 1% in fees, now you're down to $1.29 million.
So far people think this is all they're paying is 1% to their advisor. But when you add in the mutual fund fees and the back end fees, look at your money.
With 3% fees, you only have $952,000 after 13 years. Less money than what you started with. 4% fees, 5% fees. So it depends on what accounts you have, and we can do that fee analysis for you. But as a percentage
of your money,
total cost of fees, I mean, look at this 3%. $551,000 you've paid in fees over 13 years or 14 years. That's more than half of your original account balance. So it's really important to make sure you have a handle on how much you're paying in fees.
And that's why fees are hard to figure out, hard to find, because investment advisors don't want you to know that, because that's how they make their money. Again, insufficient data, right? You don't have enough information. So that's where we come in. We are going to give you more information and help you identify all those different hidden fees so you know exactly what's happening.
So here's an example of a client. The names are changed for confidentiality, but Bob and Carol, both age 65, retired a couple years ago. Bob was an engineer, and Carol was a state employee. She has a pension, and they both have Social Security. They have $1.6 million in assets, which they weren't spending, not because they didn't want to or need to spend them, because they were worried. They were worried about the money running out, how much taxes they would pay.
The fees, crashes. The beneficiaries, what are their kids going to get? The daily volatility going up and down, watching the market every day.
And like many of you, they actually had an advisor for 22 years, but they didn't have any written plan of how much they could safely spend and still leave money for the kids and minimize their taxes. So what we did for them, we did a fee analysis and a risk analysis. So in this case, we found that they were paying $49,000 a year in fees.
They thought they were only paying 1%.
But they were actually paying on average 3.08%.
And they were actually at 1.25%. They didn't even realize they were paying that to their broker. And then with the added mutual fund fees in there and variable annuities they had in there with its fees, it was a lot of money.
And so we also did a risk analysis and found the next time the market crashes, like 2008, they would have lost $790,000. And that's why they were worried, because they didn't want to have to start taking money out and then have a big drop, and now they don't have any money left. And so when we put together a strategy for them, it was able to reduce their fees to only $17,000 instead of $49,000 a year.
That means the majority of that money, $32,000, they were able to keep in their pocket and let it grow and continue to grow.
And we were able to reduce their risk so that next time the market crashed, the most they could lose is $150,000. And that's only a 9% loss. Again, to recover that, instead of having to gain 97%, they only have to gain 10% to recover that money.
So we help them reduce their fees and reduce their risk, so they're in a much better situation. They feel a lot less stressed, and now they can actually enjoy their retirement without feeling stressed.
So now let's get to taxes, because that's the third part of it. So let's understand the recent tax law changes. And then we're going to identify tools and tax strategies specifically for retirement distributions. Now, when we have this discussion, we're going to avoid the political and stick to the actionable. So it doesn't matter who's in power, what they said they're going to do, what they want to do.
Yes. Now, I also want to identify again, I'm not sure if I said that in the beginning of our webinar, Daniel is a tax attorney, so he does have a little better understanding of the taxes than most people.
So, again, we're not going to really talk about what laws might happen. We're going to talk about what's already there for your taxes. Okay? But you will pay taxes. Resistance is futile. There's Star Trek again. So anyway, so you will pay taxes. The question is, how little can we make that tax bill? Okay, these are the married filing jointly brackets.
And you can find that on Google.
Yeah.
I mean, it's nothing new here. I just want to show you that all the tax rates did go down with the Trump tax cuts, and they may be going back up. We'll see, but that's what they are now.
And the difference is with long-term capital gains is different than income tax. A lot of people feel like they're going to pay 15 or 20% in capital gains, but there actually is a
0% tax bracket for that.
0% tax bracket for the first 80,000, and really over 100,000 if you're married, because you have that standard deduction. So important to keep that in mind. Sometimes you can have capital gains and not pay any taxes.
So proper planning will help you take advantage of the low tax brackets.
So what are deductions? A lot of you are familiar with deductions. We're going to talk about more complicated tax planning strategies in a second.
So we're going to go through this real quick, and I apologize if it's too quick, but you're welcome to set up an appointment. Just click that button, and we can go over that individually for you and exactly how it affects you. There's a standard deduction of $24,800 for married or $12,400 for a single, and that's in lieu of itemized deductions. Most people are taking the standard deduction because it is so much higher now. Unless you're a business owner, you own rental properties, things like that. There's a lot of other things, and the cap of $10,000 in property tax was a real big shocker for a lot of people that live in nicer homes and nicer areas like we do. And but that does not affect your rental properties, so you can still deduct all the property taxes and all the things for your rental properties.
All right. But the real tax system is a lot more complicated than just the tax rates and deductions, right? Because that we have required minimum distributions now, capital gains, how do they affect your other income? Social Security is taxable. We'll talk about that.
When to take it, how much is taxable, all that stuff.
Right. So all these different things. So we have a slide on a few of these. First up is required minimum distributions.
So we call them RMDs for short. And when you turn 70 and a half, used to be, now it's 72. When you turn 72, even if you don't want your money out of your 401k, you will have to take it out.
What about IRAs?
Same thing.
TSPs.
TSP, anything you deferred, any tax you deferred, you put it aside for later. Now you have to start taking it out because the IRS says, hey, you know what? We didn't collect taxes then. Now we want our taxes. You got to start spending that money. So how do they figure that out? Well, if your balance is $500,000, you take that $500,000 divided by 25.6, which is the chart, which you can Google the chart, RMD chart online. This is what it looks like. And if you look up there, now that you've started 72, the chart's still the same. Distribution period 25.6 years. And that's what you divide it up, and that's what you have to take out.
So you don't know how long you're going to live, but the government does. They say at age 72, you're going to live 25.6 years, and so that's what you need to divide it by. Many of our clients, when they first come to us, they have most of their assets in tax-deferred accounts, IRAs and 401ks, and they're very upset about this upcoming required distribution because they don't need all of that distribution, and they have to take it out anyway.
They didn't realize that all of it's going to be taxable at probably a higher tax bracket than they were paying before, and we can explain why that is. They were always told, "Oh, you're going to be a lower tax bracket. You're going to be a lower tax bracket." It doesn't really work that way because as we get wealthier, we tend to spend more on nicer things and have vacations and have less deductions when we're retired. So
now let's talk about capital gains. What are phantom gains?
So a lot of people have no idea about mutual fund pass-through or phantom gains. So what happens? Let's say I'm a mutual fund manager and I bought Apple stock 10 years ago and now it's appreciated a lot. And now I see all this trouble with China and I think, well, I'm going to sell some Apple stock, take the gains, and reinvest it into something else. So I do that. Now Daniel owns a mutual fund. He didn't make any decision on buying or selling any of the stock. But do I, as the fund manager, have to pay the taxes? No, because I'm using his money. When I'm using his money, he's got to pay taxes. So he gets a tax bill at the end of the year for something he never even did.
And this is why you sometimes get a 1099 from your investment account, even though you didn't take any money out.
Now this doesn't affect your deferred accounts, things that you're not paying, haven't paid taxes on, because that's going to be till later. But anything that's after taxes, you will get phantom gains on those changes. And then the rebalancing will also trigger that. So if you have it set on rebalancing, automatic rebalancing, that means you sell high and buy low. It automatically does that after a certain period of time. Well, that's also going to cause some phantom gains that you're not spending, but you have to pay taxes on. And then there are long-term gains that can create ordinary income tax. Can you believe that? You thought you were going to pay the long-term capital gains, and now it's ordinary income tax? Wow.
And then there's also, in addition to the regular tax rates, you have a net investment income tax if you have a lot of capital gains, annuity payments.
You mean the IRS didn't take enough income from me?
No, there's more taxes. And so that's additional 3.8% on top of the other taxes.
So basically, if you're making a lot of money and you also have a lot of investments, you'll pay an additional 3.8%, which is your fair share, as they keep saying, of taxes. Now, Social Security, brief overview. So many of you guys, really don't care about Social Security as much, but it's very important, and some of you guys don't understand it exactly when to take it, how to take it. But you can start at age 62, and you have to take it by age 70.
And let me know what year were you planning to take Social Security? Send me a comment or answer the question. Do you want to take it now, as early as possible? You want to wait as long as possible? What's the best thing? So full retirement age is usually 66 or 67.
That means that you won't get penalized if you keep working and you take Social Security.
Right. So if you're younger than full retirement age when you take Social Security, you may not be able to work, certainly not more than $18,000 of income. Then it starts to reduce your Social Security drastically.
So every $2 of income you make over that, $1 of Social Security goes away, never to come back.
Now, your spouse's income does not count for that reduction, right? So one spouse can retire at 62, the other spouse can keep working, and that first spouse can take all their Social Security without any reduction.
But what if I have rental income?
Rental income is not going to count for that either. This is only earned income.
So rental income is not really earned.
Right, it's a passive income. Potential benefit stops increasing at age 70. We actually had a client that came to us for the first time to the first meeting, and he's like, I haven't taken my Social Security yet.
And he was 72 years old. It doesn't go up. So he actually got the 2 years back, and he got a lump sum, which is good. Social Security made him right, but you don't want to wait longer than that.
Yeah, there's no increase after that. So there's a couple reasons why somebody might want to take Social Security early, even though it's less money the earlier you take it. And there's a tax reason, which we'll go into in a second, and there's also a opportunity cost reason. And also, it reduces the strain on your investments, because if you have money coming in from Social Security, you don't have to take as much out of your other investments this year to have the same income.
So it allows them to grow and appreciate in value a lot more, and you're able to spend more money in long term.
All right. So how is Social Security taxed? When I first heard this, I was mad. So is a tax coming out of my paycheck to begin with, and now I'm going to pay taxes again when I get Social Security?
I solved that. I said, Daniel, you're so young, you don't have to worry about Social Security because you're not going to get it anyways.
So for those of you who are going to get Social Security, this is how they calculate the taxes. The government is very good at making up a name like provisional income that's only good for one thing, in this case calculating Social Security taxes. 50% of your Social Security benefit plus ordinary income plus dividends plus capital gains plus non-taxable interest like muni bonds that would normally be tax-free, they even count to make Social Security taxable. So how does that work? Well, you get your provisional income number, and then you do these complicated calculations. Let's look at the married. The married threshold is over $32,000, then up to 50% of the Social Security could be taxable. If your provisional income is over $44,000, 85% of your Social Security could be taxable.
So that doesn't mean that's how much tax you pay. It's how much of it will be taxable.
Right. And so if that wasn't complicated enough, we're going to complicate it further by showing you an example.
It's supposed to make it easier, but...
Yes. So let's say there's a couple that comes to us, and they are going to live on just $60,000 of reportable income because they have some tax-free sources as well, which we'll not get into right now. But Social Security, $20,000 of Social Security with a $40,000 IRA withdrawal is $60,000 of income. And they said, look, we could each activate Social Security for $40,000, but we're just going to activate one spouse Social Security and let the other one grow. So that's how much they're taking. So the provisional income is only $50,000. If you follow these calculations over, you look on the right side, total taxable benefit is $11,100 out of their $20,000. So a little more than half is taxable. But what if we give them a different idea? What if we say, okay, both of you can activate Social Security now. Let's go ahead and do that. So now you can take $40,000 from Social Security, and you only have to take $20,000 from your IRA. So that lasts longer. The IRA would last longer. But you also have $40,000 of provisional income instead of $50,000, because half of Social Security plus $20,000 is $40,000. When you do the same calculation, your total taxable benefit is only $4,000, so much less. How does that look on your actual tax return? And so here we have the tax return. And so the first couple had $40,000 in IRA, $20,000 of Social Security. Out of that, $11,000 was taxable.
And you add back in the other income, $40,000. That was the IRA.
And so total taxable income is $51,000. When you apply the standard deduction, you only get $24,000 of taxable income. So total federal income tax is $2,500.
Not too bad. It's not a really horrible rate. But let's look at the other couple. What did they do?
They paid zero in federal income tax.
You mean they had the same amount of income, and kept that $2,500 and spent it instead of giving it to the government.
Exactly. And so, in fact, because their standard deduction is actually higher than their taxable income, they could take out another $2,500 from their IRA and still pay no tax. So they'd be $5,000 richer. And this works at larger incomes as well. I use the smaller income as an example here, but this works at any income level. You can take steps proactively to reduce your taxes.
So think about this. They get an extra $5,000. They don't pay any taxes, and they're taking their Social Security earlier, so whatever they would have made up later would not matter.
And their IRAs are lasting longer because they're not draining them as fast. So all sorts of things are a benefit for doing that.
Planning is very important.
So let's look at an actual case study, another case study, with the real tax system. So John and Jane, married filing jointly, age 72. They have $60,000 of combined Social Security. They have $15,000 of capital gains. $45,000 of required minimum distributions that they didn't want to take out, but they have to anyway. So their total income is $120,000. And so when we put them into our software, tax software, this is what it shows us. It shows us that they actually pay almost 50% on a portion of their income before dropping back down to 22%. How did that happen? They should be in the 12% tax bracket, not the 50% tax bracket of that income.
That's because there's a cascading effect. When you take money out here, it adds to the provisional income, it adds to this and this and this, and that cascades into a higher tax on a certain portion of your money.
So let's show you how it looks. They took $1,000 that were required for the IRA, and that should have caused them $120 in tax at 12%, right? But what actually happened is that caused the $120, which caused $850 of Social Security to now be taxable at 12% for $102, which caused $1,850 of capital gains to now be taxable at 15% for $277. So the total additional tax burden on that $1,000 withdrawal was $499.
The IRS loved it.
So you thought you were in a 12% tax bracket, and because you're lower tax bracket when you retire, you're in 12% tax bracket now, but you're paying 50%. And that's because of the cascading effect that all these different income sources have on your taxes. So we want to make sure we put you in a position that you can be proactive and reduce that before it gets that bad and that out of hand. Okay? There's 4 different tax buckets. Most people, when they come to us, all their money's in tax deferred. But there's 4 different tax buckets, right?
So what does it mean? Taxable is your income, right? You make money, it's taxable. Then you put some money aside, that's tax deferred. That's in 401ks, TSPs, IRAs.
And you can save money in a brokerage account. That'll be taxable later as well for capital gains.
And then you have income tax free. What is income tax free?
Income tax free are things that you don't pay taxes on, such as Roth IRA. Roth IRA is income tax free. Life insurance is income tax free. Municipal bonds are tax free. Cash in the bank, if it's not growing yet, that'll be tax free because there's no growth.
Right. And then you have your last bucket, 4th bucket, income tax
and estate tax.
And estate tax free.
And so that means anything that's in an irrevocable trust, something that's not in your estate, you don't pay estate taxes on. So these are the 4 tax buckets. And
so that's real diversification. The diversifying in different mutual funds, it's all in the market, it's all at risk. This is how you really diversify your assets by how it's going to be affected.
Right. So what are some tools for higher net worth families? You want to diversify among account types, not just stocks and bonds mix. So you want to have IRAs for sure, but Roth IRAs also, including Roth conversions, non-qualified taxable money. So that's what you should be thinking of when you think diversify. Diversify from both things that are at risk and things that are guaranteed, and then things that for tax purposes you diversify.
And we got a question that came in that's very pertinent to this. What if I make too much money to do a Roth IRA?
Well, we'll talk about that in a second. There's a really cool tool for you on the next page. Use tax-deferred products only where appropriate.
So it's not the saving thing of everything. You don't want to always use tax deferral. That's what we're taught over and over again. Just defer taxes, but it's only on certain times.
Right. Properly blend withdrawals from different accounts, and consider which assets should be held in which account type, because certain assets are better for certain account types. Take advantage of rental properties and the deductions they entail. This is something you won't hear a financial advisor talking about very often. Why? Because if you're investing in a rental property, that's not money that I can charge a fee for, right? So
Where's my fees? Where's my fees? I want my fees.
So a lot of advisors don't talk about rental properties, but they can provide some really good benefits, both for inflation protection and for tax deductions in retirement.
And free vacations.
And free vacations if you have a vacation rental. Get ahead of the game for RMDs. Take money out of your IRAs before it's too late, before you're required to. And there's some reasons why you may want to. Use Roth conversions. That's a question that somebody asked. We'll talk about that in a second. And use CRUTs. We'll have a slide on each Roth conversions and CRUTs because those are two really important things. And then also plan ahead for legacy. What are your beneficiaries going to pay? Okay. So what are Roth conversions? Many of you have heard of Roth IRAs. That means unlike a regular IRA or a 401k that you get a deduction first when you put it in, but then you pay taxes at the end. The Roth conversions are, a Roth IRA will be you pay taxes now, but then you don't pay taxes later. You have this Slinky? Do we have a Slinky here?
Yes.
Let's grab the Slinky. So this is a silly little illustration. This is the Slinky.
So this is how much money you have. You can either pay taxes on this, or you can defer it. As it grows and grows and grows over your lifetime for another 30 or 40 years, you can pay taxes on this. I would much rather pay taxes on this than this.
And so that's the beauty of a Roth IRA. But many of you have made too much money in your careers to contribute to a Roth IRA because there's income limitations. And there's also caps on how much you can put in. So you may not have a lot of money in Roth. You may have a lot more money in regular IRAs and 401ks. Well, there's good news. You can do a Roth conversion, and there's no income limitation for a Roth conversion. What does that mean? You pay taxes up front on your IRA or a portion of your IRA, and then you never again pay taxes in the future on that money. There is no income cap. There is, however, a 5-year rule. So you have to wait 5 years or 59.5 before you can access the principal. And you do have to wait 5 years after the conversion before you can access the new growth on that. So let's say you want to convert $100,000 of your IRA to Roth. That means you report $100,000 extra income. You have to pay the taxes on that. And then that $100,000, if you're over 59.5, you can spend that money immediately. But you have to wait 5 years for the future growth to be tax-free. But then it is tax-free all for the rest of your life. And even there's no RMDs, no required distributions, and there's also no taxes for your kids either.
And also, there's a backdoor Roth as well. Some people that are still making money, they're not retired yet, they're making a lot of money, they can contribute to a non-deductible IRA and then convert it to Roth.
So take advantage of the tax laws. Sometimes it's better to pay a little more tax now than to pay a lot more later. Remember the Slinky. Pay taxes on the seed and not the harvest. CRUT is another unique option, and this is a good tax-saving option. So what does CRUT stand for? CRUT stands for Charitable Remainder Unit Trust. And you can Google it. And if you don't have a huge charitable intent, then you can forget about the charitable part for a second. Let's just talk about the tax benefits. So let's say you want to set aside some money into a trust, into this specific type of trust called a CRUT. You get a giant tax deduction for, they call it a donation to this trust. It can be up to 50% of the balance that you contribute, depending on how old you are and so on.
So you mean if I contribute $500,000, I'm going to get $250,000 in tax deduction?
It's possible. And it's great for highly appreciated stocks because there's no capital gains. So let's say you have $500,000 in your brokerage account.
And I only paid $50,000 in Apple stock, and now it's going to $500,000.
Right. So if you sold that stock, you'd pay $450,000 worth of capital gains. So it'll be 15 or 20% of $450,000 that you pay. But you can put the money in the trust instead and then sell the stocks, and there's no capital gains. And you get this giant tax deduction.
But I lose the money. I want the money.
You get 5% income out of the trust for the rest of your life.
Ah.
So you get, so if it's $500,000, and that's a $25,000 income for the rest of your life. And upon death, whatever's left has to go to charity. At least 10% has to go to charity. And if you want, you can even set up your own charity so that it goes specifically to where you want it to go.
So you mean tell me I saved 20% capital gains tax on $450,000, and I got $250,000 tax deduction, and I'm only leaving $50,000 to the charity?
That's the long and short of it.
That seems like cheating.
And that's because the IRS is still using tables from a really long time ago. I think the 60s. They haven't updated them for life expectancy. So they expect you to die soon after you put the money in a trust. So if you're healthy and you're expecting to live a long time, this can be a very good thing. So here's an example of a calculator we use. This is a client that's age 65. They put $500,000 into the trust, and they get a $222,000 tax deduction. You could use that tax deduction to offset a Roth conversion. So now you can convert $222,000 of your IRA to Roth with no taxes. And all that's going to be tax-free, and all the growth will be tax-free in the future. So we've done this for many clients, and when we do the tax analysis for them, we found that they can save by doing this, they can save several $100,000 or more over their lifetime just by doing this transaction. And so it's far more money than they're actually even putting in the first place. So that's an option. Cuts are an option, and you can talk to us about that.
So if you take a minute, go ahead and click that button and make that appointment now. Our calendar does fill up pretty quickly. We want to make sure we can do a 15-minute consultation with you, give you some ideas, and then you can decide whether you want to work with us at that point. But you should click that button as soon as possible.
So here's a question. How high have taxes been historically? Do you think they're going to go up? Do you think they're going to go down? Do you think they're going to stay the same? But how high have they been historically? What's the highest tax we've ever had in this country? You want to take a guess? I see some people think 50%, some people think 45%, somebody says 70%. It's actually been pretty high. It's actually been even higher than that. The highest has been 94%. The tax rates have been 94% in this country.
Now, we were at war, so
World War II. But even for a long time after that, the taxes were close to 90%, even after the war, in the 50s and the 60s. And then it went down to 70% for a while. So we're today in one of the lowest tax brackets and tax environments in history. And if you look back at the time, because you're thinking, well, I'll make less money, so I won't have as high of a tax rate. But look, the rate on only $10,000 back at that time was almost 40%, and over 40% a couple times. Only $10,000 of income. So think about that. You might be in a lower number of tax brackets. If there's 4 tax brackets or 5 tax brackets, you might be in the lower one. But that bracket itself might be a much higher percentage in the future. So important to keep in mind. This is why Roth conversions are very helpful, especially if taxes go up. And other tax-free buckets can be very helpful. So again, insufficient data causes undue stress. We want you to be stress-free. We want you to understand where your money is, what you're paying in fees, how much risk you have, and how much in taxes you have, and how to avoid those and minimize those taxes and fees.
So we've given you a lot of data so far. But it's still insufficient because you don't know how it applies to you and how you can take advantages, and that's where we come in.
So, real quick before we're done, we have a couple things about legacy. Some of you are interested in legacy, and then we'll have time for questions as well. But planning for legacy, estate or gift tax. Make sure you have a power of attorney. This is an important one. If you don't have a power of attorney, then you and maybe even your spouse won't be able to pay your bills or refinance the house or do anything if something happens to you where you're not.
And this is a very simple document that can be done very quickly and easily. Just contact us, make that appointment. We'll send it to you. It's free. You can download it, sign it, get it notarized, and it's very important to have.
Right. And so estate taxes. Are you going to pay estate taxes? Well, there's an $11.5 million exclusion per spouse for the next 5 years. So unless your net worth is over $22 million as a couple, you're probably not going to have your kids pay estate taxes. If you die in the next 5 years.
Right.
So after that, it goes down, and it's always changing. They change it every few years, so we'll see what it is. 40% tax on the excess. Okay. Now, gift tax is the same as estate tax. So can you give your kids money, and do they have to pay taxes on it?
Yep, up to $11 million each person.
Yeah. So what about this $15,000 we're talking about? $15,000 exclusion per beneficiary. This does not mean you can only give $15,000.
All this means is you can give $15,000 per child, per person, per adult, without having to report it at all. If you give more than that, all you have to do is fill out a gift tax return. Doesn't mean you have to pay taxes on it. You don't pay taxes, and your child does not pay taxes. But It's just recorded because it goes against your exclusion, lifetime exclusion. Because if you gave $1 million away this year, nobody pays taxes. You don't pay taxes, and your daughter or son doesn't pay taxes. But that $1 million shows up on a report, so the IRS knows now instead of having $11.5 million tax exclusion, you have a 10.5 because you've already used $1 million as a tax exclusion. So proper planning is very important.
And efficient transfer. If you want to leave money to your kids, make sure you have wills and trusts set up. So it goes outside. Trust helps it go outside probate, so the court doesn't have to be involved, and your friends and neighbors don't know all the intimate details. Believe it or not, that's what happens with a will. There's all sorts of fancy trusts you can put in to avoid taxes and avoid probate and so on. Beneficiary designations are really important, though. We had somebody come in, and
I felt really bad for this family. They came in and they wanted to talk to us because they were very, very upset. The ex-husband the father had just passed away. He had divorced, remarried, had new kids, new wife, and he passed away from a massive heart attack. It wasn't unexpected. and all his money still went to his ex-wife.
The other half that he gave half away when he got divorced, but the other half went to her when he died.
Right, and they were wondering why is that? Why can't that be fixed? Because he's already given her half all of his assets. Well, because he never changed the beneficiaries. Because he never changed the beneficiaries, the old spouse still got everything that she was a beneficiary on, regardless of what his will said, regardless of whatever else it was, because beneficiaries trump everything else.
Real estate is actually a good thing to leave to your kids.
For now.
Right, because you get a step up in basis. So that means when you sell a real estate investment, you would usually pay capital gains. But if you leave it to your kids, they don't pay any capital gains currently. There are some talks of changing that, but again, we'll stick to what's here now.
And there's ways to sell real estate and not have to pay capital gains, and you can talk to us about that as well.
Mutual funds, stocks, bonds. Inherited IRAs, there's special considerations for those. There's new tax laws that say you cannot stretch IRAs anymore. So your kids will have to pay all the taxes on your IRAs within 10 years.
So some of you might have inherited an IRA from a parent or grandparent and been able to stretch it out over your lifetime and pay a little bit of taxes each time. And that's no longer going to be available for your kids or grandkids.
So IRAs are actually one of the worst things you could possibly leave to your kids. If that's your plan right now, you may want to think about making some legacy changes. So what are some other retirement pitfalls before we get done? We talked about market risks. That's kind of like a big tax, because if the market crashes by 40%, that's the same thing as Uncle Sam taking 40% out of your investments.
Because you got to remake that about 80% to recover.
Long-term care costs. If you don't have a plan for long-term care, that's still a plan. It's just not a very good plan. So make sure you plan for long-term care, plan for inflation. I know that's the I word.
And it's really becoming real now.
Yep. So, and then also boomerang children moving back home and taking up expenses.
Is there a solution for that, Daniel?
We do have a solution for boomerang children. Here's one.
The kids won't move back home if you can't find it.
So there's an idea. We also had a client that decided to sell their house and buy a boat and live on the boat. So that's their retirement home now. So you can do that. We talked about some new legislation. There's Roth conversions opportunities, Social Security optimization. IRA required distributions changed, no more stretch IRAs. There was a special IRA withdrawal rule for last year. If you took advantage of that, you could contact us if you have questions about taxes for that. So basically, you're at a crossroads now in your plans. So you can keep risking, you can keep worrying, you can keep going without, and so you make sure your money lasts as long as possible. And basically, you're doing the same thing and expecting different results. And that's the definition of insanity. Or you can get a second opinion. Learn how to protect your money. Increase your income and reduce taxes and fees. Feel secure and enjoy life. Learn to take control of your money.
So reach higher ground.
So what is involved in the process to reach higher ground? Remember, we are a Higher Ground Financial Group. We are fiduciaries. And what is our process? So if you click the link and set up an appointment with us, here's what you should expect. So there's 4 stages in our process. Stage 1 is getting to know you. We'll assess your current situation, identify and define risks, and understand your dreams. What's the cost for this part?
Nothing.
No cost for this part. Okay, so no cost. Go ahead and set up a meeting with us. It'll be 1 to 2 meetings for about 15 minutes to do this part of it, to assess where you are and identify the risks. And then stage 2 is your pre-qualification offer. It's kind of like pre-qualifying for a mortgage or for a credit card. You get your congratulations, you've been approved for this is what we can do for you.
So at this stage, once we have your information, we can be able to put together how much in taxes you can actually save, how much risk can you avoid, how much in fees can you avoid, and what your income plan can be if you do the changes that we recommend. So we clearly identify all the costs to working with us at that point.
And that being the 3rd meeting. And then we have stage 3. At that point, there's commitment. So there's no commitment to work with us until stage 3, after you've seen the pre-qualification offer and we've had those meetings.
And you understand all the fees and costs that are involved, because there's nothing at all that's going to cost you anything at all until that point, and then you decide whether you want to work with us or not. Exactly. After we prove to you how much in taxes and risk and fees we can save.
Exactly. And so then you would commit to working with us, and we talk about the details. We can fine-tune the plan. We talk about products at that point. And then stage 4, implementation. So we can begin making changes. Some of them will be small, some very large, depending on your situation. For some clients, we just need to make a little tweak, and then they're in a much better position. Sometimes by just changing a little tiny thing, you can save several $100,000 in taxes over your lifetime. And so we'll talk about that, and depending on what applies to you.
All right.
So that's all we have time for today. Do we have any questions?
Please type them in, and we'll try to answer a few
Somebody's
questions.
asking, are we fiduciaries? Yes, we are fiduciaries.
And what does fiduciary mean? Fiduciary means that we will always advise you and give you the best advice based on your situation and not for any other purpose. So always in your best interest.
And how can I find my fees? How somebody's asking, how can I find my fees? How do you figure that out?
So there's a lot of complicated ways to do that. We can help you do that. Just make that appointment, and we will take a look at what you are currently have and actually list out the fees, and we'll show you exactly where to find them, so you can verify those are your actual fees.
And then somebody's asking about Social Security. They're saying they were married and previously married and then divorced, but they never really made a whole lot of money. So can they claim their ex's Social Security? They've heard that's something they can do.
So you have to be married for at least 10 years, and then you can claim your ex-spouse's Social Security. It does not affect them, unfortunately. I know some people would rather hurt them, but it doesn't affect them at all. But you can get their Social Security or half the Social Security. Okay. So, and
then another question. I inherited some money, and should I use the money to pay off my house?
That's a definitive no. Don't do that.
It is a more specific question. We want to get in front of you and talk to you specifically about that situation. But in all likelihood, we would say don't ever pay off your house. It almost never makes sense to pay off your house for any reason. And we can explain to you why, and we can prove to you with math and science why that is. So when you meet with us, we can talk about that.
But if emotionally it makes you feel better, hey, pay it off. What we want to do is give you more information so you make better decisions based on good quality information and all the pros and cons to everything.
So again, click the link and set up a meeting with us. Our calendar fills up very quickly, so make sure you get on there with us. We have way too many people to follow up with that have requested to meet with us. So make sure you get on our calendar right away so we have time to see you. And we'll look forward to speaking with them.
Another question is, what if you only have a couple questions, you really don't want to do planning with us? That's okay. Just make that appointment. There's no obligation. It's free. You attended the webinar, and part of our promise to everybody that attends the webinar is you can make that 15-minute web meeting. It is a web meeting, so there's no time out of your day or my day, only 15 minutes. We show up on the computer, and we can answer a couple of your questions, and then you can part company, and we'll still be friends.
All right. Well, you guys have a good time, and we'll look forward to seeing you soon.
All right. Take care. Hope you learned something.